Good morning, good afternoon, good evening, wherever you are in the world. I'm Nicolas Veron for the Peterson Institute for International Economics. It's my pleasure to start the session on the bank sovereign nexus in emerging markets and in the context of COVID-19, of course. And we couldn't have better speakers for this than Tobias, Adrian, and Anna Gelpern. Let me first thank Jessica Parada. I don't do it on every session, but there is a whole team, and Jessica is really the hidden pillar of this series. So thanks, Jessica, for all the work in the preparation, and all the colleagues at the Peterson Institute Meetings Department and Communications and support. But let me first introduce our speakers. Tobias Adrian studied at Goethe University in Frankfurt, at Paris Dauphine University in Paris, at the London School of Economics in London. So that's a perfect European background. And of course, at MIT, Massachusetts Institute of Technology, where he got his PhD in economics in 2003. Tobias then worked at the Federal Reserve Bank of New York from 2003 to 2016 in several positions, including as head of capital markets research and associate director of research. And in January 2017, he joined the International Monetary Fund in his current job as a financial counselor and head of the Monetary and Capital Markets, MCM, department, which is really in the IMF, where all the expertise on financial services, financial systems, and also macro financial linkages rest. And the MCM is the lead department for the preparation of the Global Financial Stability Report, of which the next iteration is coming up, I guess, in a month or two, Tobias, right?
Yeah, exactly, in April for the spring meetings.
So the work of the MCM is very much about systemic risk, and that echoes Tobias' previous research career, which was extremely distinguished. He has been a pioneer, in particular, of measuring systemic risk, including with Marcus Brunnermeier, who is now also affiliated with the Institute, and has a stellar publication record, and also a record of other policy involvements, including with the Bank for International Settlements. Anna Gelpern is here, not for the first time, actually for the third time, and you're also a pillar of the series, Anna, now, thanks. And she studied at Princeton, at Harvard Law School, where she got her Juris Doctor degree, also at the London School of Economics, where she got her Master of Science degree, and then went into legal practice at Cleary Gottlieb Steen and Hamilton in New York and London. She worked at the US Treasury from 1996 to 2002, and then was in an academic career successively at Rutgers Law School, American University, Washington College of Law, in visiting positions at University of Pennsylvania and Harvard, and since 2013 at Georgetown University, where she co-directs the Sovereign Debt Forum, which is a collaborative initiative with other institutions. She's also been an expert with the United Nations Conference on Trade and Development, many policy advisory functions. She was at the Council on Foreign Relations after her stint at Treasury, and since, I think, 2003, of course, at the Peterson Institute for International Economics. With that introduction, Tobias, over to you.
Well, thanks so much, Nicola, for the very nice introduction, and thanks for having me on this panel. So I'm excited to talk about a topic that we are going to elaborate on more in the spring meetings. That is the sovereign banking nexus in emerging market economies. So I've brought some slides, so I'm going to start sharing my screen, and I'll take about 10 minutes to go through the slide deck. So the COVID-19 pandemic has brought to the fore the relationship between sovereigns and banks in emerging markets. The nexus has not only intensified in emerging markets, but has also become more complex as interdependencies between sovereigns, banks, and corporates have deepened. Emerging market governments have provided unprecedented monetary and fiscal policy support to cushion the pandemic shock. As a result, conditions in the corporate sector have become more dependent on the continuation of such measures, especially in countries where the recovery has not fully materialized. This in turn has implications for both sovereign and banking sectors. As fiscal vulnerabilities are elevated, economic uncertainty is high, and governments have large financing needs, a tightening of global financial conditions could generate complex policy trade-offs for emerging markets. And so this is what my talk this morning is about, is to go deeper into the sovereign bank nexus and what we could expect going forward. So let me first give you some big picture facts. Public debt, as we know, has increased across the board in emerging markets. It surged to an all-time high of 67% of GDP on average in 2021. Those are the red bars in the left panel. Importantly, it is emerging market domestic banks that have stepped in to finance this growth in public debt, as participation by foreign investors has continued to decline, notably in local currency bond markets. Taken together, emerging market bank exposure to the government has increased significantly to a record of about 17% of bank assets in 2021, as shown in the right chart. And of course, across countries, you have a big variance there, with some countries having significantly higher shares than the 17%. But you clearly see this upward trend during the pandemic years. At the current juncture, emerging markets are exposed to the risk of an adverse shock triggered by a tightening of global financial conditions as monetary policy is normalized around the world. After an initial wave of sovereign rating downgrades induced by the pandemic-related sell-off in 2020, a negative credit rating outlook for emerging markets has picked up again on weaker growth prospects, high debt servicing burdens, and concerns about external financing dynamics as higher yields in advanced economies are realizing. CDS spreads have also remained elevated relative to before the pandemic, that's shown in the right chart. At the same time, local currency government bond yields for most emerging markets have also increased in recent months as inflationary pressures have taken hold and foreign participation in local currency bond markets has declined. As higher fiscal vulnerabilities have occurred, a significant tightening in global financial conditions could sharpen the sovereign borrowing costs for emerging markets and potentially trigger an adverse sovereign bank feedback loop by fueling debt sustainability concerns that would adversely affect bank funding conditions and balance sheets. Although emerging market banks are generally well capitalized relative to the global financial crisis, thanks to all the regulatory reforms that have been phased in since 2010, this is shown in the left chart. In the case of sovereign distress, losses could be significant for some economies given the size of banking exposures relative to the CET1 capital ratio that's shown in the middle chart. For example, a simple scenario analysis shows that in sub-Saharan Africa, on average, haircuts of about 30% on government debt exposure, which are plausible given historical standards, could generate large capital shortfalls. These banking systems are thus put particularly vulnerable sovereigns into distress. Furthermore, banking sector health depends on the viability of corporate borrowers, which has been under strain during the pandemic because of the slowdown in economic activity. In most emerging markets, the sustainability of corporate debt, as measured by the earnings capacity relative to debt, shown in the left chart, has declined as corporate revenues have fallen. So you can see the red dots, which are the 2015 to 2019 averages, are generally above the 2020, end of 2020 ratios of EBITDA to debt. While it is difficult to fully ascertain the soundness of bank balance sheets at the current juncture, because of regulatory flexibility and other financial sector support measures in place, non-performing loans are more than 1/10 of total loans in some countries. That's shown in the right chart, and could edge up as loan repayment moratoria and other policy support measures are unwound. So if anything, the right chart is conservative. An adverse shock to the corporate sector, for instance, because of tighter financial conditions or a weaker than expected economic recovery in emerging markets amidst the spread of new COVID-19 variants, could put pressure on the banking sector in the most vulnerable countries and pose risks to macro-financial stability. Such a shock could amplify the strong sovereign bank nexus. In this regard, it is worth noting that countries in which the banking sector is more exposed to domestic sovereign debt are also generally those with higher public debt. That's shown in the left chart, where you can see a clear positive relationship there between the ratio of government debt holdings to total holdings and the ratio of government debt to GDP. A sizable share of domestic bond holdings is marked to market in major emerging markets, which could lead to immediate capital losses during sovereign stress. Such losses could be particularly problematic in countries with a higher bank sovereign exposure, as these banking sectors are generally less well capitalized. And that's shown on the right chart, right? So you see that for those countries with a higher ratio of regulatory tier 1 capital, you generally have lower sovereign bank nexus, while the ones with a high sovereign bank nexus tend to have less capital. So that is quite worrisome.
And of course, UA here is for Crane. I'm mentioning it because I guess it's something we.
Oh yeah, yes, there are many abbreviations here. Yes, I apologize about that. Yeah. Now, this is the key economic slide. Conceptually, there are 3 channels of transmission of shocks underlying the sovereign bank nexus, which tend to interact and amplify vulnerabilities across sectors. First, banks and sovereigns are linked through the exposure channel. A rise in sovereign spreads could reduce the market value of government debt that banks hold and use as collateral to secure financing. As a result, banks could face higher funding costs and liquidity strains, potentially restricting their capacity to lend to the private sector. Secondly, the second channel relates to the safety net or government support provided by banks, provided to banks in the form of implicit or explicit guarantees. An increase in sovereign risk reduces the ability of governments to support banks, increasing stress in the banking sector, and in turn, raising the need for actual fiscal support that further weakens the sovereign balance sheet. Third and finally, the sovereign stress can also affect banks indirectly through the real sector by raising borrowing costs for corporates, or through fiscal consolidation and policy uncertainty, hurting corporate performance and increasing banks' credit risk. Of course, these 3 channels are intertwined and could work in both directions. Stress in the banking sector could also lead to sovereign stress. In our forthcoming April GFSR, we explore the strength of these 3 channels in emerging markets. But here I would like to note that the risk of a mutually reinforcing doom loop has increased in emerging markets after the COVID-19 pandemic, both because of higher sovereign exposures and also because of greater reliance of corporates on public sector support. In this context, a relevant observation is that the strong nexus has amplified sovereign debt and financial crisis in emerging markets in the past. The table shows the frequency of past banking and sovereign debt crises across emerging markets and advanced economies over the last few decades. Banking and sovereign debt crises have been particularly prevalent in emerging markets, frequently occurring together or in succession of each other, as indicated by the twin crisis. Their incidence has typically increased after tightening of global financial conditions, which tends to induce a reversal in cross-border capital flows that makes it harder for both sovereigns and banks to obtain funding and leads to sharp currency depreciation that further strains sovereign and bank balance sheets. Notably, the fiscal cost of restructuring and supporting the financial sector associated with crisis has also been significant in emerging markets. That's the right chart, suggesting a possible transmission of bank stress back to the sovereign. Furthermore, the deterioration in credit quality as proxied by NPLs during banking crisis has been twice as large in emerging markets as in advanced economies, indicating the existence of a strong macroeconomic channel. So this is my last slide, and I'm running out of time, so I'm going to be a little bit quick here. So these are our thoughts around policy, and I'm sure this will come up in discussion. So number one, more targeted and efficient government spending and strengthening of medium-term fiscal frameworks is, of course, first order. Secondly, considering measures to avoid excessive sovereign exposures of banks, such as appropriately calibrated capital surcharges on sovereign exposures above certain thresholds after the economic recovery has taken hold. Robust sovereign debt resolution frameworks, I'm sure that Anna is going to talk about that a little bit. Banking crisis management and corporate insolvency frameworks are very first order. And of course, promoting deep and diversified local investor bases to strengthen market resilience is first order. So let me stop here. This was my opening. I'm going to stop sharing my screen and turn back to Nicola.
That's great. Anna.
So, Tobias, Nicola, thank you so much for including me here. This is a topic that's just never ceases to excite, and I don't know if there's anybody waiting for your GFSR with more passion and anticipation than I am, because of course you started this conversation a year ago with your spring 2021 Global Financial Stability Review, where you talked about this growth of bank exposures to their sovereigns, and the analytical framework that you show with the three channels is particularly fruitful, it strikes me, and worth pushing on and elaborating. So here's where I would love to see a bit more conversation, I guess, or focus. So the last time we were obsessing about the doom loop, it was in Europe, right? And Nicola has all the solutions, and I won't go there, but I do wonder what your thoughts might be on the difference. You kind of went there in the last few slides historically, but what about right now at the moment? How different is the problem of sovereign exposures and the doom loop risks in the emerging markets today versus Europe then, and other advanced economies perhaps, but Europe in particular now? And I'm not seeing proposals for a banking union anywhere in the solutions slides, so perhaps we can expand on that. If I can show just one slide, Nicola, if you don't mind, and it is a Venerable Peterson Institute slide. This is from Bill Klein's 1995 debt book. And I forget the precise title, but I'm sure we can put it in the show notes. But, there are bank and sovereign exposures, and then there are bank and sovereign exposures, right? And what's interesting to me is that, once upon a time, sovereign crises created banking crises elsewhere. But the pattern seems to be quite different now. It seems like the foreigners flee, the debt flows back into domestic banks, and therein it either explodes or gets repressed away, or, so I wonder if there are any cross-border dimensions to what you're talking about. In other words, even regionally, I mean, I saw Nigeria is off the charts on one of the dimensions. Across Africa, are there, I'm thinking Greece, Cyprus, right? Are there banking systems where the loop is not all domestic, but perhaps regional? And are there vulnerabilities we should look for? If there are any regional differences, particularly, Latin America looked pretty good in a lot of the slides, but, not great. But those are some really big economies, many of which are experiencing serious issues. And finally, to your solution slide, I'm all for each and every one of those things, but I'm also, I could see an alternative slide which says something like, regulatory forbearance, financial repression, and regime change, and various other things that are probably and perhaps sadly more common in history, and particularly given the time constraints, right? So all of the proposals you put on the table sound exactly right, but I mean, let's even talk about the better sovereign debt resolution frameworks, from your lips to God's ears, right? But it's been going on for some time, and I'm not sure that we can achieve any of those in the foreseeable time frame. So realistically, are we looking at, goodbye mark to market and hello regulatory forbearance, or is there a time frame, component to this that we could unpack a little bit? I'm not going to go into digital and crypto dimensions of this, but perhaps if we have time left, we could talk about that. So thank you again. This is just fantastic and a treat.
Thanks, Anna.
To both of you, yeah, Tobias, do you want to reply? I also have tons of questions. I note also that Anna mentioned Bill Klein, who is in the audience, so I encourage Bill to participate and intrude in the Q&A. You may use the Q&A chat of Zoom, of course, for questions. Tobias.
Yeah, thanks so much for the rich set of questions. And I think the kind of questions that Anna is asking are exactly those that policymakers are struggling with at the moment. So when comparing emerging markets today to the European Union 10 years or a decade or so ago, I think there are arguments on both sides. So on the one hand, today we have pretty dramatic monetary tightening. There was a little bit of tightening as well just prior to the sovereign crisis. That was when Trichet was still there, just before Draghi arrived. Inflation was somewhat unexpectedly high, so the ECB did tighten, and that was certainly part of the trigger. But of course, vulnerabilities had already been extremely high. So if it hadn't been that, something else would have certainly triggered the sovereign banking crisis in Europe. But of course, today we also have a big shock. Many emerging markets have already raised interest rates very dramatically, in particular in Latin America, but also in emerging markets around the world, and more could be expected there as the major economies are tightening. And so that is certainly one negative impulse that could be large in magnitude, right? Real interest rates somehow have to go up to get inflation down globally. And when real interest rates are going up, that sustainability is more of an issue. And then that is going to feed back into the banking sector. So I think the shock that we are set up for is very clear. How big exactly the magnitude is going to be remains to be seen over the next year or so, but the potential for the stress is certainly there. So that I think goes in the direction of emerging markets today, probably facing a bigger shock than what the European Union faced. But of course, on the other hand, when you think back of Italy and Greece 10 years ago, the kind of sovereign debt to GDP ratios were extremely high. So they were way beyond what we see in the typical emerging market. But of course, emerging market institutional setups are much more fragile and less developed in most countries, not in all countries, but in most countries. So, on the one hand, you have less overall level in terms of debt to GDP, but on the other hand, resolution frameworks and safety stops are perhaps less developed. Now, in the European Union, they were not that well developed either, but the European Union had as an aggregate pretty deep pockets, and eventually came up with the resourcefulness to backstop the European Union as a whole. And of course, emerging markets don't have that kind of backstop. The IMF is there, but there's no.
Sorry to interrupt you on this, but I'm intrigued that you don't mention the fact that those countries can devalue, which Greece and Italy, of course, couldn't. The fact that they were in a currency union was a big part of the bank sovereign vicious circle at the time. So of course there is foreign currency debt for some of those markets, and that kind of is similar, but they also have a lot of domestic debt. So how do you view this? I'm obviously particularly interested by this comparison between what you presented and the eurozone a bit more than 10 years ago. How do you see this difference of the currency union versus possibility of devaluation, leaving of course African currencies unions aside, which would be especially.
Yeah, absolutely. I fully agree with you. There's some currency unions, but in terms of global GDP, it's fairly small. Now, for those countries, it might be a particularly difficult additional challenge. But say for the typically emerging market, there is exchange rate flexibility, and a devaluation can certainly serve as a big buffer for the macroeconomy. Now, at the same time, when you have a big devaluation, we already saw some currencies devalue quite a bit in the past year. It depends on what emerging market you're looking at. There's a huge variance across emerging markets today. But some emerging markets have already developed quite a bit, and that has helped as a shock absorber. But of course, it does raise other problems as well, right? To the extent that there are foreign investors, those might go out more and more, so that the domestic banks actually have to absorb more of this debt. And of course, this is where Anna's third point comes in about financial repression and forbearance. So there are all kinds of pressures, particularly on state-owned banks in those circumstances, to then serve as a backstop for what the global investors are selling. There's not as much domestic debt that is held by global investors, but there's some. And on the margin, it is going to make a difference in terms of sales, in terms of pricing. And as I pointed out, a fairly large share of these domestic sovereign bonds are held in mark-to-market portfolios. So this is going to hit the bottom line, the capital of the banks pretty directly.
So we mentioned this kind of narrative of the bank sovereign nexus with what I think you very elegantly presented as a sovereign exposure channel, safety net channel, and macro channel. I'm doing a little bit of archaeology here, and maybe it's irrelevant, but my recollection is that this way of picturing it was really invented at the IMF actually in 2011 when Olivier Blanchard in particular was at the economics department in the context of the eurozone crisis. So would you say there has been a kind of direct download of this analytical framework from the eurozone to emerging markets, or would you rather say that it's always been like that and the eurozone just picked up on ancient wisdom?
So I think Anna's remarks were quite telling here, because of course she went back to debates that were held in the 90s about the debt crisis of the 80s. And clearly in the 80s, that was a lot about Latin America. And a key factor there was the exposure of the global banks to emerging markets in Latin America. And of course, we know the history. There was quite a bit of restructuring. The Brady bonds were finally generated as a result. And now, what was different at that time, of course, is that it was still possible in a fairly straightforward manner to get everybody in a room that mattered. Today, that is much more complicated, as the investor base, the international investor base, is very fragmented, right? There are the banks, the insurance companies, pension funds, asset managers, hedge funds, etc. So you have a huge dispersion in terms of global investors. And that goes to the second question that Anna asked me. So what about the cross-border exposures? So, you know, in domestic debt, there's relatively less cross-border exposure than in hard currency denominated debt. So in that sense, that goes in the right direction. But on the other hand, there is some. And if there's any debt restructuring of domestic debt, of course, all those complications are coming in there as well. And, you know, today, the world of sovereign restructuring has become a lot more complicated. And I would add to that, you know, that in many countries, the sovereign debt resolution framework and the bank resolution framework, they both are challenged. It depends on what country you're looking at. There's, again, a large variance, but in some countries, you have issues on both resolution frameworks. And that would certainly be another amplifier, is that there's quite a bit of uncertainty as to what would be the endpoint if things go bad.
So that's, I take that as a diplomatic reference to China. And we have a question from Greg Smith, who asked, there's China getting active with funding emerging markets, infrastructure projects, providing liquidity. So is it making the IMF or World Bank irrelevant in future? That's his question. I would kind of broaden it to how does it, I mean, is there this whole new phenomenon on which China, of course, has contributed a lot of China becoming a big lender to many of those emerging markets. How does it affect the bank sovereign equation? I'm not talking about the, you know, the issues of sovereign debt restructuring in general, because that's not really our issue here. But in terms of the bank sovereign debt, including, by the way, with any intrusion of Chinese banks in those markets, what exactly is the China effect behind the numbers you showed us, Tobias?
That's an excellent question. Of course, it's difficult to give a precise quantitative answer because we don't have very good data that shows these exposures directly. But I would make 2 points here. And of course, you know, Anna has done a lot of work on that. So I would also really like to hear her views on these issues, right? I mean, clearly, there is a part of sovereign exposures in emerging markets and developing economies that is debt to Chinese entities. So those are a variety of entities, including banks, development institutions, but also corporations. And you know, that is another complexity in any restructuring discussions, is that there is another player on the table, and, you know, different entities have different incentives, clearly. And, you know, it's a very different world from the late 80s when you had 10 bankers in the room. Nowadays, you would have to have dozens and dozens of different types of institutions, including some Chinese and, but also other, you know, private institutions. So it is just very complex. You know, of course, there's the transparency question then as well. So it's not always that easy to understand what these exposures are exactly. So in the work that I presented you here, we have done a lot of effort to be as comprehensive as possible. But of course, we do rely on published data, and you know, not everything is necessarily published.
Now on China?
Well, on China and on publishing. So look, the work I did on China with my co-authors is very much about what the contracts say, right? And, you know, we're always surprised when what the contracts say are not what the contracts do when, you know, crisis hits. what I'm curious about, and the crisis this makes me think of, is the Asian financial crisis and when the Japanese banks were stressed, right? And the regional effect that had. From what I understand, and Tobias has far better, information on this perhaps, is that none of the countries individually that we're looking at could bring down, systemic Chinese institutions in the way that, say, Mexico could have brought down money center banks in the United States in the 80s. But at the same time, as you said, exactly right. I mean, on the margins, what are the effects? And then, of course, any sneeze by a small institution could be systemic in a small borrowing country, right? So in some ways, it's kind of the back and forth effects that I'm concerned about, and also the way in which China manages distress in its banks. And frankly, I mean, the 80s, same thing. I mean, nobody's worried about, sadly, a small borrowing country when they're dealing with advanced economy bank problems. That's a concern. On transparency, I mean, Ted Truman had this question about, well, is there a time when too much transparency is too much? And well, yeah, that's probably right. I mean, again, Asian financial crisis, when it turned out that, Thailand's reserves were not really Thailand's reserves, that strikes me as too much transparency. But in some ways, that's because there was too little earlier. And that's what I mean about the need to distinguish measures in the middle of the crisis. Probably not the time to go transparent overnight. Whereas, depending on where you are in the cycle, maybe beforehand, thinking about a path of disclosure rather than a moment of disclosure might make sense.
Yeah.
And Ted Truman, which you mentioned, Anna, has this question which goes in the same direction. It's a question for you, Tobias. We're almost always in favor of greater transparency, but what is the mechanisms that you have in mind, and is there any research that supports this as a positive contribution? So of course, that there will be more color, I guess, in the Global Financial Stability Reports when it comes out in April, but can you give us an indication of what you think could be a path of progress at this juncture?
So I think ex ante, so now, once you're in a crisis, I agree there are difficult trade-offs, and it's a complicated question. But from an ex ante point of view, if you are in a time of booms where you think that you might end up in distress at some point, but at the moment everything is fine. From that ex ante point of view, generally having more data, better disclosure is good because that allows investors and borrowers to really understand what they are getting into.
Right.
So, yeah.
There is a question which, in a way, is related on the fact from Barbara Opper. When you show home country sovereign debt held by local banks, is it all in local currency, or is there a significant foreign currency component to that?
So again, there's a huge amount of variance across countries. Of course, institutions like the IMF have advised countries for many decades at this point to move into domestic debt, right? Develop your domestic bond markets, develop a diversified investor base for the domestic bonds. Of course, that is a challenge in some countries. So there are some emerging markets, I'm thinking of Chile, for example, where you have a fairly diversified investor base. You have pension funds, insurance companies, as well as banks that are buying these domestic bonds. But that's not true in all emerging markets. And in many emerging markets, the banks remain the prime investor for domestic debt. So even if you would develop domestic debt relative to hard currency debt, you end up with these domestic banks, oftentimes state-owned banks or partially state-owned banks, or regional government-owned banks or so, as being major investors. And so this is again where the connection between the bank and the sovereign is intensified and could amplify any adverse shocks. Now, of course, what is extremely unusual in this COVID crisis is that hard currency debt issuance was pretty much available until very early this year. At the moment, it's turning a little bit because global financial conditions are tightening. But up until 4 weeks ago or so, pretty much any borrower, including the riskiest borrowers, could issue hard currency debt. And that, of course, was a side effect of extremely easy financial conditions that are a result of the easy monetary policy that were addressed, that were used to address this terrible COVID-19 crisis. So it's a very unusual crisis in that many countries were able to issue hard currency debt in a fairly straightforward manner.
And that partly answers a question from Hiroaki Baba, who is asking how the rise in US interest rate affects the soundness of banks in the emerging countries. Do you want to make any other brief comments, Anna or Tobias, on the current financing conditions, or we leave it at that for the rise in US interest rates?
I mean, I would just note that I just saw a little message popping up that said that the CPI print this morning was pretty high in the US again. And so, markets are repricing as we speak, and the repricing goes in the direction of more tightening than what was priced in, say, 3 months ago or so. So clearly we are entering into a territory where global financial conditions have to tighten to some degree. And, global financial conditions are very important for domestic financial conditions in emerging markets. There is a huge spillover effect of global to domestic for emerging markets. And that's going to be a challenge for a number of countries.
Now on this?
I'm not an economist, so all I have to say is 1982. But
you work at the Peterson Institute for International Economics, so you're certainly more of an economist than I am. There's a question. If I'm also if I stay on the plumbing side, there's a question from Bill Klein. Which is ostensibly on Turkey, but is also on the mechanism more generally. So I read the question: Turkey has negative net reserves because of swaps with domestic banks. Does contingent risk from banks help explain Turkey's poor credit rating and high spreads relative to sovereign debt ratios? So of course, you're very welcome to comment on Turkey specifically, but you can also comment on this kind of derivative channel more generally. Tobias?
On Turkey, let me just say that, of course, there are macroeconomic policies that have been pretty stark and that have fueled both inflation, financial stability concerns, and devaluations. And so, the fund view at this point is that monetary policy probably should be tighter than it is. Concerning contingent liabilities, and that goes back to transparency. So in some countries, you have pretty good data about those contingent liabilities, but in many countries, of course, the contingent liabilities are what is extremely intransparent. I'm thinking back of an example in the European crisis in Greece, right, where certain derivative positions that were off balance sheet were suddenly uncovered, that were of fairly sizable magnitude. And, such contingent liabilities are certainly present in some countries, and that would make the sovereign banking nexus generally worse.
Anna?
So this actually is somewhat related because of the structure of some derivatives contracts, but we haven't talked about secured debt. And the one thing that occurred to me now is that if the loop is purely domestic, when all else fails, sovereigns are sovereign and you change the law and you figure out who gets the collateral. It's not pretty in the rule of law scheme of things, but it's conceivable. When collateral is pledged to offshore entities and governed by foreign law and foreign banks, et cetera, there's not a whole lot that the government can do about it. So that you could see, foreign currency revenues, foreign currency assets being locked up offshore in ways that we're not seeing right now, and that is somewhat concerning to me, I guess, in this context.
Yeah, absolutely. And I think in some cases that have been discussed in recent years, of course, that collateralized debt has not been very well known ex ante. So it changes basically your assessment of net worth and sustainability for the remaining debt that is unsecured. So it is very first order for a number of countries. I don't know, Nicola, whether you would allow me, but Anna also raised the crypto question, and that of course is another
and we also
factor.
have a question from Anna Lund about this. She refers to El Salvador, of course, and she's basically asking how the crypto changes the landscape for the bank sovereign dynamic.
Yeah, so I would say that the crypto really changes the overall macro picture, because in many emerging markets and developing economies, what we see now is that the capital outflows, so cryptoization, is becoming quantitatively large. It's difficult to put an exact number of it because there are no official statistics, but there's quite a bit of anecdotal or evidence from various sources of data that suggests that some of the most vulnerable emerging markets have this capital flow, which of course from individual investor point of view, might make sense, right? Because you say, well, the currency is depreciating. If I go into a foreign currency like the dollar, the euro, or into crypto, which by the way has just risen tremendously, perhaps that is quite interesting. Of course, in the past 3 months, we saw many crypto assets lose up to 50% of value. So I don't know whether it's that interesting anymore, but for a while, certainly we did see quite a bit of capital flows related to that. And that generally just makes the sovereign weaker. So in the sovereign bank nexus, there's the strength of the banks and there's the strength of the sovereign. And so the sovereign generally gets weaker due to this cryptoization, which we have certainly observed.
Do you have any orders of magnitude at this point of those emerging markets which are most affected, with what you describe, and the circumvention of capital controls with the use of crypto? Nigeria comes to mind. For smaller emerging markets, how high can the ratio get in a way?
I don't have a number to share at this point. I'm sorry about that, but I would call it large for some countries.
Interesting. Anna?
Well, it's just, and this is really a shout out to my students. We were trying to figure out, how do you think about a lender of last resort in this context, right? So who lends what to whom, even in a world where there's no hard limit on the on the volume of the asset out there. I mean, it's just the safety net. The geography of the safety net is so much harder to figure out deliberately. It's a design feature. How does that hold up in crisis is really hard to figure out.
So I'll come back to maybe the starting point and the analysis of the bank sovereign vicious circles. There's a question from Philip Weber on the famous Leuven and Valencia data set of financial crisis, IMF working paper 12/163. He is very specific. And they write only 1% of banking crises in our sample are preceded by a sovereign debt crisis within 3 years prior to the start of the banking crisis. So Philip is observing that this figure is surprisingly low, seems to be a historical fact, but do you think that banks' exposure to sovereigns has increased compared with the time of that data set in 2012 to an extent that implies that this ratio will be meaningfully higher than in the past? Tobias?
Yeah, so there are two effects. I think on the one hand, the sovereign has become riskier, so debt to GDP has gone up. And there are all the issues that we just discussed in terms of the plumbing that could make things more challenging. But on the other hand, of course, banks are safer generally, right? As I mentioned at the beginning, I mean, especially if you go back to the 1980s, right? I mean, bank capital is just so much higher. So
how much of that is Basel III versus just collective learning, etc. in your view?
Basel III is very important, but it is also the learning from many crises where emerging markets have realized that having a safe banking system is very first order, and we really see fairly high capital ratios in emerging markets, oftentimes higher than in advanced economies. So I do think a lot of learning has happened there. I would also say that many emerging markets have high reserves now, right? It used to be the case that, the 97 crisis is all about the lack of reserves. And, many countries, take East Asia in particular, have pretty high reserves. Also, many Latin American countries have high reserves. So that way, the current account, the capital account element is perhaps less of a worry, but the exposure of the sovereign, of the banks to the sovereign is certainly a concern going forward. So, to answer your question concretely, I could imagine that these statistics might change in coming years if we do see, worse outcomes than what I anticipated right now.
Anna?
I don't really have anything on this particular.
On what you just said, Tobias Polschiu is asking a question about state-owned banks. So he says, for instance, NPLs of Chinese banking sector, real estate and all that can be more serious at some bank, as some banks are state-run. Well, you could make the other argument that it makes it easier to manage, but can you talk more about how to improve the current monitoring and governance in emerging market banking systems? And I would add a related but separate question, which is, how much does it matter that the banking system is state-owned versus private sector owned?
Yeah, so let me make 2 points. So one about China first. I mean, of course, the situation in China is somewhat different than in other countries because there is fiscal space in China, right? And there isn't any current account issue. Chinese exports are extremely strong. There's fiscal space. So in principle, the government has the tools. And of course, the legal setup and institutional setup in China is such that the government can do things that, are more difficult to do in other countries. So in principle, the government has both the space and the tools to address, many of the issues that one might expect coming down the line to the banking sector, say from real estate or so. We certainly have seen some distress in the smaller banks in China about 3 years ago. And, there were various ways to address them, but, there was no question that the government did address them eventually. So I think China is quite unusual in that respect. Secondly, in other countries, I mean, that's not necessarily the case. So when the sovereign is very weak and, a large share of banks are state-owned, say 60, 70%, we see in many countries, then this regulatory forbearance and the financial repression is coming into place very often. And that's a point that Anna made at the very beginning, right? So, if you have a sovereign that is bankrupt and banks that are bankrupt, typically, this is where financial repression and forbearance come in. We oftentimes then go into countries and we help to consolidate, resolve, recapitalize, because that's the only way. You have to improve the health of the banking system in order to get the economy going again. And so, yes, you resolve, you restructure, and you recapitalize. We have done this in many, many countries. I have a team of resolution and crisis experts that are doing just that, and they are certainly busy.
Yeah, the men in black of the IMF also have a bank troubleshooting practice, indeed.
You're feeding theories.
What you said about India, by the way, echoes a question from Edward Glossop, and exactly that. And I guess your mention of India, unprompted, does answer his question. Anna?
I wanted to flag something that also came up in the Q&A, and I think Piroshka asked that question about central banks, right?
Yes.
I think that we really should.
Question from Piroshka Naji Mohashi. When central bank hold sovereign debt, is there a way to kind of provide relief through that channel, right?
And again, just not to keep harping on Europe, but the biggest holdout in Greece was not a hedge fund, right? The biggest holdout in Greece that
That was the
53,
ECB.
56, right? That was a central bank that shall remain unnamed. Oh, I don't know. The ECB, the European Central Bank, right? So I am curious, Tobias, when you were talking about resolving and recapitalizing, I mean, it surely looks different when the bank is the central bank, right? So if all this debt flows into the central bank that are already packed pretty seriously with sovereign debt, then what? Question mark.
And actually, I have a question which connects to that. You said there's fiscal space in China, which is clearly the case. But do I read your response correctly that you think there are basically no limitations to the fiscal space in China?
No, there are limits everywhere. So every country can run out of fiscal space. I think history has shown that. But I just don't think we're that close at the moment. So in the case of China, so I think they have ample space, and they're very proactive, and they have shown that they are willing to take bold steps in the face of trouble. On the one hand, there are some issues, but on the other hand, you have a government with a lot of tools and space. Now, let me talk about the central banks a little bit, and let me just flag that we put out a paper in December on asset purchases in emerging markets. So it's a little bit of a framework for how to think about asset purchases. And so we distinguish small-scale and large-scale asset purchases. So small-scale asset purchases are done by emerging markets for market functioning reasons. So you see distress, illiquidity in certain segments. Central banks have come in particular in the 2020 COVID crisis, fairly aggressively to address those issues. That is different from large-scale asset purchases, which aim to ease financial conditions and which are very much what the Federal Reserve or the ECB has been doing for many years. So in our view, these small-scale asset purchases, if well governed, can be very helpful for emerging markets, but it has to be, so the central bank has to be set up in a way where these purchases are done in order to achieve central bank goals, i.e. inflation stability and financial stability, not government financing. So if you're conditional on having sufficient independence, asset purchase programs can be helpful and powerful, but you have to be sure as a central bank that you can get out of it in due time when your central bank objectives no longer necessitate those asset purchases. And that, of course, is not the case in every country. And so when you have
dominance rears its head in many places.
Exactly. So if you have a weak institutional setup in the central bank that might not be able to withstand the pressure from the government, you can end up in fiscal dominance, monetary financing, and all the issues that are well understood.
Tobias, I know you have to leave us at the hour sharp, but I really want to ask you the last question from Arnab Das, who is asking a pretty basic one, but I think very important. Do you view these issues of bank sovereign doom loops as idiosyncratic, country-specific, or do you think there could be a contagion effect across emerging markets, as we had in a way during the Asian financial crisis and Russian financial crisis, in the next phase? And unfortunately, we won't have a lot of time to discuss that, but I would like to have your short answer.
Yeah, my short answer is, at the moment, it looks more idiosyncratic than systemic. So I think there are specific countries that are particularly exposed at the moment. There could be spillovers, but getting to a systemic crisis is quite a bit out at the moment, I would say. So I think we would certainly start with idiosyncratic here.
Anna, this?
Nothing. Good question, Arnab, and fingers crossed.
On this note of hope and expectation, thanks so much to both of you. This was a very rich exchange. We covered a lot of ground. This was superb. The next session of financial statements is on Friday, the 25th of February. We will have Saule Omarova, who recently was in the news for her nomination for controller of the currency. We will discuss credit allocation, kind of thinking holistically about whether the financial system is fit for purpose in terms of credit allocation. So pretty fundamental questions. That's on February 25. And again, many thanks to Tobias Adrian and Anna Gelpern for a very, very thought-provoking conversation today. Thank you very much.
Thank you.
Thanks, Nicola, and thanks to the audience. Bye-bye.